Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. We're gonna go and tackle a question here. So I'm gonna, well, it's a question for most people, but I'll give you my opinions on it. It deals with trying to buy a bottom versus buying a confirmed breakout. I am completely fine with people buying confirmed breakouts. I have no disagreement there. But I'm going to give you an example of what I do, whether it's right, wrong, or indifferent. My approach, and I'm applying that approach even in this current bull market. So we're going to go back and look at the previous bull market, what I would have done if I could have done something differently if I was looking at that bull market at this time, and what I'm applying this go around, and the difference between buying a confirmed breakout and buying a potential low. So you can disagree with me, you can agree with me. And you can also deploy both of these at the same time to different companies. And I'll let you know what I mean by this. So let's dive in here and see what's going on. I'm going to use uranium as an example. It says, why do most people focus on trying to buy the bottom instead of waiting for the confirmed breakout? So which is better according to you? Some people will say, how do you know that the stock is going to go up? That's really the question. How do you know it's going to go up before you have a confirmed breakout? So what I do is I look for alignment. Alignment is what is important to me. So let's go back to the last bull market, and I'm going to show you a couple of things that I look at, and where I would purchase and what I've done this bull market here. So we can look at uranium. And the first thing I would do is I look for a cheap commodity price. So when we look at commodities versus the S&P 500, we've got these buy points that were bottoms. Bottom, bottom, bottom. Now, it doesn't mean that every sector and every company in those sectors bottom at these exact times. So let's just say that we've got a bottom during these times, and it starts to move upward. All right, so here's the bottom in 1999. We start to see it, and then we get a first wave and a second wave, a third wave, pullback, and then the last fifth wave. And let's say we know that it occurs under certain market conditions. Let's say it's under an expansion phase of real estate where you get more money into the system. So we're starting to stack market conditions. So we see a cheap commodity to stock ratio. It goes up. It's during an expansion phase of real estate that occurred somewhere in this time frame forward. We had that alignment, which means money coming into the system. It means inflation and all of those things. So we have that alignment. And what I'm going to do is I'm going to go look at sectors during that time frame to see what is cheap. And if we have that alignment, it starts to move up in 99 or so. I could go look and say, okay, what does crude oil look like in comparison to gold in that time frame? And in that time frame in 99, we have a cheap, very cheap crude oil to gold ratio. Now, when this thing starts to move up back into this channel, or maybe you don't know the channel exists at that time, but it's starting to move up. You could go look at companies like SM Energy at 98, 99. You go and look at that chart, and you say, okay, I know I'm cheap. We're in an expansionary phase of real estate. Yes, yes, yes. 99, we're breaking out of this little guy. This is where I would buy. Right there. $5. I would buy it at 460 something. 460 something. Now, if someone didn't know that the commodity stock ratio was going up, they didn't know about the expansionary phase of real estate, they didn't know about all that stuff, well, then you wouldn't buy it here. You'd buy it at a much higher level, and you'd wait for a confirmed breakout. But at that point, $4 and something cents, and let's say you sold it somewhere at the end of the commodity, the stock to commodity ratio, that's going to get you in the ballpark of this area here. So you're up around 40 something bucks or so. It's about a 10 bagger. A 10 bagger. Now let's go over to uranium. Let's say we see oil going up in early 99, 2000, and you go over to uranium and you're looking at CCJ. And the uranium to gold ratio is cheap. Here, let me see if I can pull that up. This is the uranium to gold ratio, which sometimes these things don't like to pull up. But let's just say it doesn't show it back here. But that was cheap back in the day. It was very cheap. We go and we look at CCJ, and we say, okay, let's look at Camco. Camco's our leader, and I know that Camco's the leader. So we've got this 1, 2, 3, 4, 5, 6, 7 accumulation cylinder. Where would I buy this? I'd buy it right here. No confirmed breakout. I'd buy the pattern. I'd buy the fractal. This is 1, 2, 3, 4, 5, 6, 7. And what do we have during this time frame? We have in 02. What do we have? This is called the bear trap too. This is the bear trap. We've got the commodity to stock ratio that's already put in one wave and is in the second wave of that thing. So we would be buying in this bottom here. We've already got wave 1 and wave 2 situated. We already know that we have inflation coming into the system. And we know that we've had a slowdown in the overall markets. We just went through this. We just went through this with uranium. Now, if you're looking at CCJ and you say, okay, 02, this is starting to break up, right? This is already 03, and we're moving in 03 upwards in Camco, right? So Camco's moving higher. What do we know about uranium? What do we know about uranium? We know that they have big moves. We know that they were cheap. Uranium versus gold ratio is cheap, and it doesn't pull up the data on this here. It was very cheap in that time frame. We know that crude oil is cheap. We know that crude oil is outperforming gold during that time frame. It's moving higher. We know that we're in an expansionary phase of real estate. We know that we've got inflation coming into the system. They lowered interest rates, and the housing market starts going up, and that inflation starts coming in the system. It's not about knowing if a company is going to go up or down. It's knowing about the market conditions that impact money flows in the market. You're just front running it. Now, I can go look at some of the small uranium companies, and if you look at the uranium in general, they have a pretty high success rate of moving up, and you can increase that success rate if you look at the ETFs to see if the money flows coming into the ETFs also include the companies that you own. So if you go into URNJ, let's just say, you go to URNJ, you go to the Sprott Miners ETF, and you go into the holdings, and you say, oh, okay, let's look at the holdings here. Oh, Bannerman Energy's in it. So maybe Bannerman or Global Atomic or ISO Energy or any of these, they're in the holdings, and they have some sort of holding. You could do Next Gen Energy, and then you could go back and you could say, okay, there are ETFs in there buying this. So if we look at Bannerman, we pull up Bannerman last bull market. And you'd say, okay, what would be my approach here if I were to take an approach, a realistic approach? Well, I know Camco, which is our leader, is going up in 2003, 2004. This is 05. 05 is back here. And we also have other ones that are lagging, that are smaller explorers during that time frame. And let's say that you want to try to buy a bottom. Well, we know that commodity to stock ratio in 04, 05 is going up undoubtedly. We know that Camco has broken everything. That's got confirmed breakouts. Everything's moving higher. Why wouldn't I buy some of these explorers that are lagging is the question that I would have. And you know what? I'd buy it here. I'd probably buy some here. I'd probably buy some down here. And I would buy some on the breakout. And it doesn't have to be large amounts. It could be small amounts, dollar cost average in, and then pump the stock here. What is my cost average basis during this time frame if I was doing that? Well, this is probably $2 or so. This one's below a dollar. That's about $1, and that's below $1. So let's just say it's $1. My cost average basis for this stock is $1. And let's say I cost averaged in 5,000 bucks. Okay, $5,000. I have $5,000 at a buck. Now, the other one, if you buy in the confirmed breakout, your average is $2, let's just say. And you ride it all the way to something like, let's just say $30, right? So you wrote it up here, it came back down, you sold it at $30. The ultimate peak was $39. So I'm giving a big peak. Okay, $30, we got it. One returned a 15 bagger, one returned a 30 bagger. That was the difference of being earlier and doing a dollar cost average approach and then punching it when it broke out. So what does that mean in dollar terms? Well, one, you had half as many shares, right? So one, you had 5,000 shares, one, you had 2,500. You multiply it by 30. One, you have 75,000 bucks. The other, you have $150,000. That's a big difference. That is a very big difference. Now, would you wait an extra year or two to have a $75,000 difference off of a cost basis of about 2,500 or yeah, of about sinking 2,500 bucks or maybe $3,000 being a little bit early? Definitely worth it. Definitely worth it. So you already had the alignment. You already had CCJ breaking to the upside in this scenario here, which it even had the accumulation cylinder. I would have fired away down here because we already knew we were in a commodity bull market. We already knew we were in an expansion phase of real estate. We already knew that commodities were cheap to stocks. We already had all these alignments. I would have fired away, but that's me. And then I hedged myself with time. Now, could I have bought early in some of these explorers all the way back in 2003? Yeah, I probably would have bought some explorers in 2003. Let me just see Mega Uranium and how that would have fared doing that. And I would have cost averaged in, hold on, yeah, this should be right. So here's Mega Uranium. We'll go back to the other chart here. All right, so let's just say that I was early, right? And I started cost averaging in. I started sprinkling money in. This is 03 here and 04. So let's say I bought some at 34 cents. Okay, it came on down, and I bought into this little thing here. So I bought here, breakout. Yep, okay. Bought some more. It came back up, came back down. I bought some more here. All right, and then we've got this here, and we bought some more on the breakout. So that is how I purchase in my strategy. Let's say my average is in between this. So let's say it's like 30 cents. Okay, let's say 30 cents. So I bought $5,000, 30 cents. $5,000, 30 cents. And I let this thing ride up. I knew the bull market's coming. This is a little bit of money. Threw in this one, and it breaks, right? And it goes all the way up, all the way to a peak of $9. It goes all the way back down, and I sell it, let's just say at $6. All right, $6 on the way down, I sell it. So I went from 30 cents to $6. That is a 20 bagger. Now, if you had bought on the breakout here is about, let's just call it 40 cents. You bought it at 40 cents versus my 30 cents. So that's the difference, 10 cents. Now, does that make a big deal? Well, let's look at the difference in returns. If I put $5,000 in divided by 0.3, I have 16,000 shares, and I sold it at $6. I'd make $100,000 from $5,000. Now, if you have a larger portfolio, let's say your portfolio is in the hundreds of thousands of dollars, or maybe even in $1 million, whatever it is. Okay, you've been saving a good chunk of your life, and you're going to deploy, $5,000 to some of these small uranium companies in each position, maybe even $10,000, whatever it is. It depends what you want to allocate to it. And let's say you buy, 10 of these, 10 of them. Now, you don't want to, I know a lot of people say, well, how do you keep track of the company? Guys, this isn't about keeping track of the company necessarily. It's about spreading your risk and not getting too overweight in highly speculative companies that don't have any sort of cash flow. It's too risky, in my opinion. So let's say you turned $5,000 into 100,000, and then we got Bannerman too. We were in that, and that blew up. And let's say a couple of them went to zero. It didn't go anywhere. Well, these carry you so much with the symmetry that it just doesn't matter. If you had a couple that didn't go anywhere, okay, even if it went to zero, fine. I blew out 5 of my positions. Let's say you allocated 50,000 to uranium. You took $5,000 positions in each of them. I just have an example where 2 of them, one was a 10-bagger, went to 50,000. This one went to 100,000. And I didn't take the absolute peak. I took it when it went down. And so you've got 100,000 there. That one there at 40 cents. You have 5,000 divided by 0.4 times $6. You'd have 75,000. So you're 25,000 less using a confirmed breakout strategy. And I'm not saying that's bad. That is very good, and your risk may be lower and your timing might be better. That's great. But I'm still walking away with hundreds of thousands of dollars more with waiting another year or two. Now, if you compound that across an entire portfolio, it could be difference of millions of dollars. So what the question you have to ask yourself is then, it comes down to dollar cost averaging, knowing the risk of the companies, and your portfolio allocation strategy, and trying to buy these bottoms. And right now, I am deploying that same strategy today. I'm still doing the same thing. I'm going and I'm bottom fishing and I'm buying patterns. If Camco, we have Camco breaking right now. And I have no problem. So this is what generally happens, guys. You get this squeezing of a pattern. You get 3 humps inside that pattern. You get a breakout to the upside, which we've gotten. And Camco has already broken a lot of its resistance areas. I think this is an accumulation cylinder, much like this over here. I think uranium is going to go to a very, very high price. And I think Camco is going to do something like, I'm not joking, like something like this over, maybe it peaks out in 2026 or something, whatever it is. This is the fractal of a different company that's leading up to the breakout of last bull market. So let's just zoom in. This is the fractal. You get 1, 2, 3, 4, 5, 6, 7. That's the accumulation cylinder of the blue guy here. 1, 2, 3, 4, 5, 6, 7 is the same thing with Camco, and now we're breaking that to the upside. Yeah, we got a little bit of a pullback. Yep, we're breaking through. We've got some resistance on the left-hand side. I get it. Relax, ride it. That's the way I see it. Now, we looked at mega uranium, right? So here's mega uranium. I'm just using this as an example. It's not any sort of thing. What do we have here? Well, it's like 1, 2, 3, 4, 5, 6, 7. Wait, that's the accumulation cylinder. Why wouldn't I buy it here? Oh, because we didn't know it was going to go down. Okay, buy it up here then. Why would I not buy it at like 20 cents, 20-something cents? And we already have Camco breaking out. I know that mega uranium is generally lagged behind it. Now, if we take a big picture view and we look at this, there's other things that we can do in terms of pattern recognition. Generally speaking, if you look at this, I'm going to have to go on logarithmic to kind of get the definition here. We can draw this across. This is about to break out. And I'm just using this as an example. So come up, here's your bottom and the break, that's confirmed breakout. And yes, I would buy on that too. We've come on down. We know that Camco is broken out in somewhere like this, right? That's an area where Camco just kept going up. What I would do, I've been buying the bottoms here. I've been buying in all sorts of different companies, not saying mega uranium. I'm just using this as an example. I've been buying it. I know that there's resistance here. I know this might not break out immediately. I don't really care. I'm going to try to get the lowest price possible. We also can see that Bannerman Also, I'll get off logarithmic here. So that's what it looks like non-logarithmic. You can see we've got this. If you look at classical technical chart stuff, um, this is the ideal buy point right here. And you could buy it on the breakout here, which we did. That's what we did on the website. We bought Bannerman in the corner here. We bought it on the breakout. I bought it in this corner over here. No, it was 2020 right here. I bought the corner over here. Why did I buy that corner? Well, I knew that oil, nat gas, everything was creating a bottom. I knew that commodities were bottoming against stocks. I knew that there was stimulus money, and we were in an expansionary phase of real estate, which is going to be highly inflationary. The inflation is what causes the rotation of assets into uranium and oil and all this other stuff. So I bought a whole bunch right here. It was actually this exact day here, that month. That's where I bought it. Now, it turned out that my timing was good. I'm not gonna time it. I would have been fine buying it even in 2017, in 2019. I would have been fine buying it in every single one of these spots for this big bull market. I have no problem waiting a few years, 5 years even, 6 years. I don't care. If this is not my biggest position, I'm gonna put 5, 10 grand in it or something like that. And buying it at this price down here, it was 2 cents when I bought it because this is split adjusted. But and we're getting a break here. It looks fantastic. This I think is going to go to a land far higher, much higher away than where we are today. So that is the strategy I've been deploying, and I'm looking at other sectors that are still down. Historically, gold leads. Gold took off in 2020. Gold took off back in 2000, 2001, 2002. We can take a quick look. That's our leader. These are leaders, and if you look, the breakout occurred in '02 in gold. And now, would I would have bought gold in the corner of this thing? I would have. I would have loaded into the corner of this. Why? Because I know that commodities were cheap to stocks, and generally speaking, gold does very well when that occurs. I would buy gold even down here. I know it hasn't broken out, and maybe I'm violating technical analysis. I was buying platinum and silver and gold all through this entire section here. I just kept buying it and buying it and buying it. Now we're getting that move up. Why did I think that this was just a matter of time? Market conditions, inflation. Now, if I had to ride through something that like a pullback, well, then I'm going to ride through it. If it came back here, I would just buy more down here. I would have gotten a cheaper price. So I don't, I'm fine with doing that. That's just my strategy, I guess. And if the ratios are telling me I've got this gigantic asymmetry, if I know that we're in an expansionary phase of real estate, which we are, if I know that the commodities are cheap to stocks, which I do, I know that some sectors lead. Gold took off. Oil's doing very well. Natural gas is doing very well. Natural gas pulled back, but oil took off. Oil's sitting on top of a pattern. Oil looks fantastic. That's another leader. Why wouldn't I buy some of these uranium little, companies, explorers, at super cheap prices? I am. Why not? Why not? I can lose 2 grand on a company, 50% pullback if I put 5 grand in it. Why wouldn't I take that bet? That would be my question. And I think we're going to go much higher. And if I have to wait a year or two, okay, so be it. With that money and the allocation that I'm putting towards it, I'm fine with it. But I think it's going to work out in the end. I think uranium has a high probability of success. The stocks that I am entering have indications of accumulation in terms of their fractals and their patterns. They could have falling wedges. They could have accumulation cylinders. That's what I do. I look at the fractal. I buy the bottom of that fractal, and some of them may not turn out in my favor, which I'm okay with because the symmetry is going to carry me to the upside. So that's my take. And I bought the bottom, I think, of uranium in 2020, pretty close. Not the bottom, but close enough. I bought close enough with a lot of my oil companies and natural gas companies. Some are up over 10x already. Some are up over 20x. Do you know how life changing that is if you bought that at that time? Now, if you a 20x, if you bought on something a little bit later, your multiple is going to be divided by something. It might be divided by 2 or 3 if you waited to buy. Then it won't be it's not nearly as much of a life changing event. 20 bagger or a 30 bagger versus a 10 bagger is a big difference. You're talking hundreds of thousands and potentially millions of dollars depending on how much you put into it. The reason I went with oil and nat gas with much heavier allocation is because the ratio was so dorked up. And what I mean by this, here's crude oil divided by gold. The ratio went to, here, let's go gold to crude oil. That's the one that I think most people, it goes over 30 as you're cheap. Look where it was over here, guys. This was just one big mess up. And I bought it over here. The momentum was already coming back down. So I said, man, I need to get on this train. There were companies selling for they were selling for $170 million, and they had infrastructure that could generate billions of dollars in cash flow. And we went to a level in crude oil that was so blown out to the downside that the opportunity, I mean, I don't know, I couldn't sleep at night. I had to get on it. So I bought a whole bunch, and that's what I did. Gold already took off. It went up. It was starting to go sideways in August. I swapped it in September, October of 2020 because it stopped really going up. And then I bought a bunch of natural gas and oil, like small, it was small cap at the time, but they were mid cap companies back during the mid 2000s. So I bought all that stuff. That's how I did it. And I'm doing it today with just different sectors. And there are sectors where you get a breakout. Like, for instance, you look at iron ore. All right. So iron ore is broken to the upside. So here's iron ore. Wait, I got to go all the way back up. So iron ore. Here's iron ore. Iron ore is already broken out. It's broken to the upside. Your confirmed breakouts there, but the companies haven't moved yet. You can also overlay what moves iron ore. Baltic Dry Index, that's broken out too. Now, some of the companies that are steel companies haven't broken to the upside, and same with the iron ore companies. What's the big risk? I mean, this is already broken. So I'm in there and I'm buying the crap out of steel. I'm buying the crap out of iron ore. I'm buying the crap out of stuff. Why wouldn't I do that? And they've got good patterns too. It's not even, I'm buying the tips of the patterns. Like, I am literally going in there and I'm cost averaging in. If this was a company, I'm cost averaging in, in the tip over here. In the bottom, if it does a false breakdown, because this is already broken to the upside, the thing they sell, the thing that they sell is going up. So am I taking on more risk? Probably, but it's also worth the risk in my opinion. And I'm willing to ride it out. So that's kind of my strategy. And if you guys want to know the companies that I'm doing it with, you can sign up to finding-value.com. You can see what I'm buying. There are steel companies that I am buying right now. And during midweek updates, I go over all this. I let you guys know what I'm doing. There's ones that we buy on breakouts. There's ones that we buy, the pattern that goes to the tip. Some of them do a false breakdown, and then we buy the breakdown as it breaks on up because the thing that they sell is broken to the upside. It's more of a strategy saying, if you can fit the puzzle together, you can be a little bit earlier. And that's where a lot of the returns come from. If you can get a cost basis that is, half as much, then you get a double in your price at the end. And I've got a lot of good success doing that. My returns the past 3 years on my original money, I'm probably on average up around, I'd say 8 to 10x is about that move that I've done on my original money that I put in. Now, the returns aren't as big because I've been adding money throughout the years in. And the setups, as you go over time, they pause because we've just been at a wave 2 pullback. So my portfolio, since I still have a lot of those companies that are 10x plus, they are flinging around all over the place. I'm over 10x on all those companies right now because they're up towards their highs in oil and nat gas, and I have a feeling that I could have the potential to have 3 or 400 baggers. Fingers crossed. I'm still riding them. They are big positions, and I'm hoping that I could do another 8 to 10x on some of them. Maybe I can get a couple hundred back. Now, there's some energy service companies that are still lagging. There's some companies that haven't taken off yet that are at pretty good buy points. Now, are they 100-bagger buy points? Maybe some of them are in uranium that are lagging. Maybe. Maybe they're 20 or 30 baggers, whatever it is. I don't know what it is. It's going to be at the end. But I'm gonna throw some money in it. I am. I'm trying to buy the bottom of some of the uranium little mining companies. I'm trying to buy the bottom in some silver companies. And what I'm doing is I'm taking some of my dividends that I'm getting and I'm reallocating it to some of the riskier stuff, and I'm swinging for the fence. Now, you might not want to do that if you don't have enough money to do that. But again, it's your money. You can do what you want. Here's another thing, right? This is a fractal of last bull market for Baltic Dry Index. Look at the fractal right there. This is last bull market. Look at how this lead in was. You get a hump, comes up, you get a 3 hump pullback, a breakout. This is the same fractal. It's the same thing that is basically coming. And this would be if it were to repeat, this would be the move that Baltic Dry Index does. If it were to repeat again. And Baltic Dry Index is cheap against everything. But guys, there's so many opportunities here. And I buy without a confirmed breakout. I buy the pattern. I buy the fractal. The fractal's repeating pattern, so I buy the pattern. I look at other commodities. We're in a commodity bull market, and I'm trying to buy the bottom of some sectors. That's what I'm doing. Right, wrong, or indifferent. I don't disagree with other people's strategies. I think it's fine to buy only confirmed breakouts, but I get in there. I buy stuff that's lagging. I buy stuff that has a falling wedge right at the tip, trying to buy the bottom of some of these uranium junior companies and explorer companies. I'm doing it with some silver companies as well because I think silver is going to make a massive move at some point with the 50-year. Here, I'll show you the pattern here, guys. Silver has just one gigantic setup here. And this is the setup here. And then it's a cup, and then this is the handle, or you can draw the handle like this. Either way, this thing's going to break at some point. It's such a big pattern here that I'm going to try to buy the bottom. Now, a lot of these stocks, what they have is they basically go up in like a 3-wave move, and then they come back. You get like a little lead-in pattern. It comes down. That's what the pattern looks like. Then you get a breakout, and then you get usually like we've been doing this, like a falling wedge, and then it breaks to the upside and goes into some big uptrend. I've been trying to buy some in this area here. I've been buying the confirmed breakout and the spots here in some sectors. And that's where we're at in some of these sectors. Some of the silver companies are down here. Some other companies, they'll create like a wedge pattern to the corner here, and you can get them at the second bottom. Some of them have like a third bottom, and yes, I am early. I get it. Sometimes they do this, and sometimes you get like a bottom that looks like that. I'm trying to buy them down here. It's not a lot of money. I'm just slowly, accumulating some of these small companies for rolling the dice here. They're lottery tickets, is what I call them. Lottery tickets that could pay out, but it's not with the majority of my money. But I'm doing it. That's me, and I'm not going to change my approach. But yeah, that's what I've got for today, guys. Hopefully you enjoyed it. Give me a thumb up for the content, subscribe to the channel, and we'll catch you guys next time. This is Finding Value.